I'm surprised every week with the amazing work of Donna Chachevsky, who's behind the scenes pulling all the levers, and we have a new opening. I really like it. Hello, everybody. I hope you're enjoying this Monday and you had a great weekend of watching football and enjoying great fall weather. I'm super stoked to invite onto this program. It's called One on One, a gentleman who has become a good friend. This person was told by me to be the guy to know by the late David Stevens. He said, there's one particular person you must get to know. This was, I don't know, a year, maybe 14 months ago, and his name is Taylor Stork. Taylor is a lot of things. He's the president of an IMB. He's also the president of Community Home Lenders of America, CHLA. It's always hard to get these acronyms. Taylor, good to see you, man. How you doing, brother?
You too. I'm glad to be here. This is exciting.
I know. We're finally doing this together.
Yeah. Listen, before we say anything else, I just want you to know that I have purposefully used, so this microphone right here, it's actually not connected to anything. It's a prop, but I wanted to look as cool as you.
That's good.
I was trying to figure out how to do, but I couldn't make it work. So
Oh,
I actually had it sitting on top of my coffee mug, so it would be high enough that you could see it.
Well, so you are at the top of a trade group, a smaller trade group that deals with credit unions, smaller IMBs, but it's you do similar advocacy work as the Mortgage Bankers Association. You're also a member of the Mortgage Bankers Association. Tell everybody a little bit about CHLA before we jump into so many issues facing the industry, including staring down the barrel of a 50% increase again in credit report fees from FICO. We'll get into that in 1 second. There was an article this morning that was alarming, but CHLA.
Yeah, so I'm a member of multiple different trade associations, to be honest, and I'm a certified mortgage banker. And I became a member of CHLA, I think 2018, 2019 ish, and then got more and more involved. And what I found was that it had this kind of aspect of the organization that took advocacy like to the next step, and they got really involved in taking action on certain issues, and often they were issues that were overlooked by other groups for one reason or another. Oftentimes these were nuanced items that were really specific to IMBs, and I loved the sense of a hands-on, roll up your sleeves approach to tackling problems for mortgage companies. Because if it's a problem for a mortgage company, it's probably a problem for our borrowers too, and vice versa. So CHLA is it's a trade association, like many others, and it is a group of people that represent IMBs. We deal directly with the decision makers in the policy space. We do a lot of advocacy and work in Washington, D.C. We get involved in a lot of projects, and we try to take on some of the tough issues that are sensitive and hard to digest.
Are you Republican or Democrat? I'm just kidding. You're like, whoa, you didn't go over that in the pregame script. Okay, let's jump into FICO, because I know you know a lot about it, and you've been very outspoken.
That's how you and I got introduced. That's how you and I and Dave all made the initial kind of connection once upon a time, not too long ago. It was right after I think the very, very first, secret 400% increase.
Well, we've had between 400 and 500% increase in the last under 3 years, and now comes word this morning. I think National Mortgage News had an article that they're hearing a 50% additional increase is coming our way. Is that even possible?
Is it possible? What would stop them from making it a 100% increase?
Great question. What does stop them, and what needs to be stopping them?
Well, I mean, look, nothing's stopping them because the FICO score is required by the FHFA and both enterprises to buy a loan. So there's one score, they all require it. You can't do a loan without it, and there's no restrictions around what they can charge. So they are a publicly owned organization, publicly owned company, and if they wanted to triple their scores tomorrow, they could.
Who pays for it though? In the end,
You do.
In the
You
end,
do.
in the end,
No, literally, you do.
in the end, who pays?
Borrowers.
Yeah, borrowers. So isn't this something that potentially the CFPB might want to take a look at?
It's an interesting question. I've talked to the CFPB a few times about this, and Director Chopra talked about it pretty aggressively and openly at the MBA's conference in New York, the secondary conference, not too long ago. I think they are looking into it. I believe that part of the reason that FICO was directly referenced on a letter to the White House, specifically to President Biden, by 34 different senators and members of Congress just a few days ago, is to encourage both the CFPB and the Federal Trade Commission to look into monopolistic and anti-competitive practices that occur when one single company is required, if you want to do a mortgage, or one single score is required from one single company if you want to do a mortgage, that Fannie Mae or Freddie Mac are going to buy.
How did FICO become so powerful?
It's an interesting question. It's a great question. And what I'm gonna say is maybe going to be a little surprising to you, but back in the 80s, the mortgage industry desperately needed a FICO score. We desperately needed a score because before Fair Isaac, I should say, introduced the score in, I think, 1986, there was no scoring mechanism. And so no scoring mechanism meant that it was very difficult to accomplish a number of issues. One, it was difficult to create a homogeneous scoring mechanism to address different borrower characteristics in disparate scenarios in different parts of the country, right? So the way a bank looked at borrower A in Louisiana might be totally different from the way a bank looked at borrower B in Reno, Nevada. And those two borrowers might have exactly the same credit characteristics. And so what FICO did, to their credit, was they created this kind of universal, consistent platform based on consistent data. And that actually did more for the mortgage industry than I think anybody really understands, because by having a unified, consistent structure for credit modeling, it enables the secondary markets to start to assign a more specific value to things like MSRs. It enabled MSRs to become more efficient. And by making it more efficient, it enabled a more consistent pricing structure so that our mortgage market is more fluid. And that is a fantastic thing. What it also did, and here's the second thing that I'll give FICO a tremendous amount of credit for, it eliminated, to a certain degree, it eliminated the very, very subjective process of sitting across the desk from a borrower and making a credit decision while looking at them, right? And so if you're sitting across the desk from a borrower and you're looking at them, you're making a very subjective credit decision that may be adversely impacted by your own personal biases. And what a FICO score does is it removes all personal bias from that ultimate 3-digit number, because it purely looks at data. It doesn't look at where you came from, where you were born, what line of business you're in, where you live, who your parents are. It doesn't look at any of those things that always creep into kind of the personal review. So those two things are critically important. But there's a problem. Those two things were 30 plus years ago, right? And so that was a super important thing for our industry, and it made lending better for our borrowers. And with that, the organization has enjoyed a certain privilege of being the only one. And when you're the only one, there's also a certain responsibility that you don't use that to your advantage by hiking scores and outpacing inflation by a 5 factor.
Well, there's no end in sight. That's the concern. Is there's no end in sight. I heard it was bandied around. There's a word there.
Bantered.
Huh?
Bantered. I think it's bantered.
Bantered around? I don't know.
We're bantering right now.
You and I are bantering. But
we are bantering.
Yeah, we're bantering. But it was thrown around. Let me just go with a 1-syllable word. That seems to be more in my lane. This possibility, I think, Rahi Chopra had mentioned potentially giving the consumer um, control over their credit. So instead of people at every lending institution needing to pull it uniquely every time, which can affect your score, um, now the consumer would own their credit. They'd have it pulled one time, and that would be theirs. So they would give permission to view it. That way, it would drive the cost down and give more control to the consumer. Is that something you think could happen, or is FICO just too much of a lobbying force?
Oh, I don't just think it can happen. I'm pretty sure it's going to.
Okay, well that's a good thing, right?
Yeah, I support it and encourage it. And so if you think about it, I can assign an appraisal, right? If I'm a developer's mortgage and we do an appraisal and my borrower says, you know what, Taylor, you're a jerk. I don't want to work with you. There's this other guy named Greg Sher.
Why do you
And
say sure and
he's a nice
share,
guy
man?
to me.
Why does everybody want to say sure?
Because surely you know why.
Share. No, share. Share.
Shirley, I can't make fun of Shirley nearly as much
What
as
if
I
I
can
called you Taylor Dork? Would you like that?
That was my high school nickname.
I bet it
Stork the
was.
Dork.
I bet it
And
was.
oh my God, shit, that's going to trend now. Oh my God, Brian View is going to start
Oh, you're
typing
screwed.
stuff on
Yeah.
LinkedIn.
He doesn't,
I'm
View
done.
doesn't,
Hey,
View doesn't
maybe
look at
now I
this.
can finally get some followers.
He-
I've got like 17 compared to your
he's
33,000.
busy. He's busy ruling LinkedIn, Brian View. He never listens to this. He's got his own award-winning show on Fridays, man. The Last Word, you know?
So if I can assign an appraisal to NFM,
Mhm.
why can't I assign a credit report to NFM?
Exactly.
It's the same
Yeah.
data. And if I can assign a credit report to NFM, then why not? Oh, and by the way, you get one free credit report a year, and nobody's ever thought about whether the FICO score should actually be included in that.
What about this idea of a buy merge using two scores? Is that going to be more costly? Is that something that could bring some efficiencies to the process, get people approved quicker? I mean, there seems to be a lot of focus on this credit thing now. As the scores are going up, it seems like it's being the dynamics around credit reporting is also it's also heightening.
All right, you got three things happening all at the same time. So let's break down what the actual three things are, right? So first you have tri-merge to bi-merge, which is not the same thing as traditional FICO to 10T FICO, right? Which is not the same thing as adding Vantage score to a FICO score option. You actually have three concurrent things all happening at the same time. And it was the announcement of those things in Nashville about 2 years ago at the MBA conference. It was the announcement of those that triggered the very first gigantic 400% increase in FICO scores.
You said three things. Are you done?
I'm never done.
You are never done. Hey, let's jump from one monster with too much control to another one. Let's talk about ICE.
Okay. Cool.
Are they a bigger threat than FICO?
First of all, I don't think FICO's a threat.
Okay.
I just think that it's needless to raise the price of home ownership for our borrowers. And I don't think that it serves a purpose. But, I'm also not a shareholder in FICO. So,
yeah.
Threat. I don't know that I'd use the word threat. I think that mortgage companies.
Have you ever done a SWOT?
What's that?
Have you ever done a SWOT exercise?
I've swatted bees away from me when they were trying to.
Yeah. The T in SWAT sounds for.
Okay.
And, when you're talking about two entities that control, I don't know, 70% of the, well, first of all, FICO, I mean, you have to have a FICO score for a mortgage to get bought. So they've got their fingerprints on 100% of mortgages, correct?
Yeah.
Okay. ICE, which
98%.
which controls Encompass, MERS, and so many other other
Pretty sure
things.
MERS has like 100% of mortgages.
Yeah, so that's what I'm talking about. Threat. I mean, they're great companies. They run great companies. I'm not disparaging them in any way, but I think you, as a mortgage person, I think it's concerning when you have a couple of companies out there that control so much. I mean, the SDK, the sunsetting of the SDK coming up supposedly in October of 2025, which is the bridge between so many third-party vendors and Encompass, is going to be basically destroyed. And that's a threat too, right? I mean, you look at one action by an entity that can affect 60 to 65% of the entire lending universe. You don't call that a threat? Do you consider that a threat?
I do. That is a threat. Sunsetting the SDK is fundamentally a threat. And here's the reason why. As a user, I started looking at what our active integrations were that relied on the SDK. And I was blown away at how many of our advanced integrations with advanced technology that we are depending on in our workflow actually use the SDK as a core to how it pulls and pushes and pulls data. I had a conference, I had a call this morning. I had a call this morning with one of my major providers that you use, Greg, and that I will guarantee you 70% of the people listening to today's call that work at IMBs or banks, whatever, use, and it's operating on the SDK, and they have stopped all development of anything until they get a little further along and they understand what they need to be doing with completely changing their integration. I have to stop developing workflow until everybody else figures out what they're doing, because we can't count on any of the existing integrations that are SDK based. Hell, I'm still trying to figure out what all is SDK based.
All right, well, let's take a time out. I have a follow-up question, but can you pull up your cup for me, please? You're very active with the cup. Is there anything in there? What's in there?
It's coffee. It's coffee.
Is it coffee?
I gave up drinking like 7 years ago. It's just coffee, I promise.
So you're drinking coffee at 1:15 Eastern time.
Oh, I drink from like 8 o'clock in the morning until 8 o'clock at night.
When does it end? That's amazing. Do you sleep or not much?
Yeah, a little bit.
I mean, there's a lot of policy out there, right? There's a lot to kick around.
It's hard to keep up with it. There's so much going on. I mean, between insurance, 1033. You know what 1033 is, right?
That is what time I normally have my second coffee.
Okay, so the 1033 open banking rule gives the CFPB broad authority to tell banks how to grant access to consumer data. And CFPB is currently reviewing it. They're in the middle of a rulemaking process. And ostensibly, what they're probably going to do is tell banks that banks have to grant API access to third-party providers so that it's easier for customers like you and me to grab our information and share it with others. It's going to have huge impacts on the mortgage business.
Basel III, that seemed to be a substantial headwind, but it seems like maybe that's lost a little steam and is going to get tabled until the election, and then we'll see what happens there. Republican administration, it probably doesn't start up again. Continuation probably gets redone in some form. Is that all accurate, or is there another wrinkle?
So Basel is a weird and nuanced thing. Basel actually was born out of the great financial crisis reset, that it was kind of like an international agreement on banking so that companies didn't all, countries and their banking industries, because we're now so internationally tied to one another, that countries didn't blow each other up by accident like we did in 2009, right? So what Basel is, it's a set of international standards. And so the American or the United States, we're going through some of our Basel stuff, trying to create our framework that is then supposed to kind of interrelate with other countries' frameworks. The Basel III endgame piece seems to be getting gutted and completely rewritten from scratch.
Yeah. So we're back.
And that's like a good thing, because there's good and bad, right? So the good thing is it will hopefully reduce the negative impact on depositories for maintaining ownership of MSRs and MBSs, because there was this terrible treatment of banks for owning MSRs and MBSs. And if banks at least can own MBSs without negative adverse treatment and hopefully more MSRs, that should create more liquidity in the mortgage market in general.
Yeah.
Which will mean that there are more aggregators to buy loans from IMBs. It'll mean that there are more rate sheets to provide competitive opportunities for borrowers. And it'll mean that there are more banks that are willing to do warehouse lending, which IMBs mostly depend on.
Yeah. Insurance, you mentioned it. How big of a concern should that be to?
That's the biggest threat in our industry.
To mortgage bankers. That's the biggest threat in our industry. Tell us why.
That's the biggest threat in our industry. As much as, if you want to put threats on a scale of 1 to 10, I put homeowners insurance on it's like an 11. So here's the deal. I'm talking to my own borrowers, and yes, I have like 2 of them, maybe 3. I'm licensed. Every once in a while, I do a loan just because I want to keep myself active. Right? I don't go out and solicit deals, but I do a loan or two. My own borrowers are getting insurance notices that their insurance premiums are increasing 40%. If my borrower, who today got a 40% increase, if they had had that 40% higher pricing a year ago when I did their mortgage, they wouldn't have qualified. Fundamentally, they wouldn't have qualified. We're going to see borrowers that we closed 6 months ago, 12 months ago. They're going to get nailed on their insurance premiums because we just watched a hurricane run through Florida right on the heels of another hurricane that ran through Florida. And the $50 billion in expense to pay for all that damage, it's going to get spread out across all of the homeowners that don't live in Florida.
And when you say that someone that didn't qualify, that did qualify, when you say that someone who did qualify would not have qualified with that premium, I think you're saying that folks that had high DTIs to begin with, 45, 48, could be as high as 60 or 70. And then we know, what does that lead to?
It means no refund.
Well, it also means defaults, right? People have to then start making choices.
So I think it leads to a couple of things. I think that a lot of the borrowers that we're hoping we're going to be able to refinance into 5%, if we get there, or lower than 6 or whatever, a lot of those borrowers are going to struggle with the fact that the cost of insurance is eating up any savings that they're going to have on their mortgage interest rate to a large extent. I think some borrowers are going to have a hard time getting insurance at all. We just watched one of the mortgage companies fundamentally pull out of Florida. They won't do condos in Florida anymore. We're going to see that the cost of managing a condominium building goes up because regardless of what state you're in, certainly Florida is going to be unique, but regardless of what state you're in, the commercial insurance that underwrites the insurance policy for the building is either going to go up significantly, or in some cases, they're going to have a hard time even finding insurance. And so that's going to get factored in. Those condos are going to get assessments to pay for that. And the owners are going to get assessments to pay for the higher cost of the commercial insurance for the building. The cost of insurance for walls in is going to go up, especially if you're in a coastal community. And then all of the damage that we've seen in Florida, but that's without even talking about fires in California, and we'll have another round of those. All of the damage right now and for the foreseeable future, it's all going to get redistributed through premium increases for borrowers.
So insurance is a hot button for sure. We'll keep an eye on that. Interest rates. I'm looking here at a bond, a yield that's just beneath 4.18. It was when Chair Powell announced the 50 bip cut, sometime around that period of time, I think it was September 16th or so, we saw a bond of 360, 362. What the hell's going on? And when do you see some relief on the rate side?
Well, let's think about what's going on. If you were an investor buying a long-term bond and your analysts all told you that whatever mortgages go into that bond today are probably going to refinance out 6 months later when rates go down a little bit more, would you buy that bond?
No, sir. Even I know that answer.
There you go. We killed the market. The refinance boom. So the bond, the problem with MBS right this second are this weird little point in time where investors are like, if I buy it now, it's just going to run off in 6 months. So if I'm going to buy it, I better put some extra premium in there in order to make sure that I cover my costs when it refinances like 6 months later. And so they're putting the premium in, and the premium is hitting the rate sheet. So that's why we're seeing rates go up.
So you've spent a lot of time talking to politicians, right? Yeah.
Yeah.
Both sides of the aisle.
Mm-hmm.
Yeah, I'm setting you up right here. Do you feel it coming? Which administration, in your opinion, would be better for housing? We've seen 4 years of both. I'm not talking about who you're voting for. I'm not asking you who you're voting for. I'm asking you who would be best for housing.
It's okay. It's the Stork and Sher administration. That is the administration that I think is best for housing.
Come on, man. Don't be like that. Do you have an opinion? Of course you do. Is it Democratic or Republican? You're hearing what they're saying. That's what I'm asking you. You're hearing what they're saying about housing. Harris has a plan. I think we've kind of seen the plan. We've got, the worst affordability.
Have we seen the plan?
Well, I don't know. That's the question. I have a lot of empathy. I have a lot of empathy for the administration from the standpoint that a lot of the pressures that they faced in housing were not in their control. I mean, you look at COVID and the cheap money and swung on back. I mean, housing doesn't move when it goes from 3% to 8 in 6 months. It just doesn't. So, I mean, obviously we're going to see less. I mean, Bob Brooksmith, who heads the NBA, said it on stage at Housing Wire not long ago that, if you want reading between the lines, he said, if you want slow and steady wins the race, go Democrat. If you want unpredictability with less compliance, but who knows what's behind the corner, you go Republican. What does Taylor Stork say?
I'll just point to Bob. I don't know. Look, so I'll say a couple things. One, I am extraordinarily careful never to actually answer these questions. This is where my political savvy comes in. I dodge these questions like nobody's business. I specifically and carefully don't comment on which administration I think is good or bad for housing. But I'm gonna give you something. Don't give me the look. I'm gonna give you something. Don't give me the look. I'll give you something. So I don't think it is fair to say that a White House administration has no impact or has a hard time having an impact on housing. That is fundamentally untrue. The White House dictates what the CFPB does, what the FHFA does, what HUD does, and a whole host of other things. And if the White House wants housing to be a priority, they can pull a couple of levers and suddenly housing is a priority. And I will tell you that for several years, nobody cared about housing. There was no White House engagement. There was no activity. It really didn't start until about a little over a year ago. And then all of a sudden it was like, oh, we all have to talk about housing. But CHLA literally sent a letter to the White House and to Treasury saying, can you please have a housing policy? Like, we need a housing policy. Can you please do something with housing? You mentioned Dave Stevens early on. This was something that he and I talked about a little bit too, is that there has been an absence of a housing policy. Fortunately, now they are actually paying attention. I don't agree with everything wholeheartedly where some of the decisions are being made, but they're focusing on it, and it's become an important item, and that's what matters.
All right. Well, you didn't really answer the question, but I understand. I understand
See,
why not.
I'm telling you, Stork and Sher, we could do it. Road to the White House.
I think it's pretty widely known you are one of the more handsome dudes in mortgage. You've got, the cleft chin, you're tall, you've got, an amazing wardrobe, you got cowboy hats, you live on a farm. Who does your shopping? Are you like going to Neiman Marcus? You're going to like these clothes that you come up with and the scarves on top of scarves. Who is responsible for that swag and style?
First of all, you're way too complimentary. I'm going to start blushing soon, and then I'll look like the wall, and then you won't see me anymore.
Well, you've seen me, so you know the bar is low. Okay, so
the bar is not low.
Take it with a grain of salt, buddy. All right.
No, the bar is not low.
No, in any case, in all seriousness, this has been a pleasure. I always appreciate your time. You're just so intelligent and so thoughtful and so careful and calculated too. That's good. Those that want to learn more about CHLA, where do they go?
Okay, so two things. Number one, I need followers. I'm really getting like FOMO and jealous of you and Brian and all these people that have like 30,000 followers, and I have 13, I think. I'm trying to get to number 14. So go to LinkedIn and LinkedIn me, because look at that. That's awesome.
How sweet is that? Right on.
Yeah, that was cool.
Yeah.
I don't know how you did that.
I didn't do anything. Trust me.
I am routinely posting information that people need to know about because there's this whole section of policy and government and stuff that impacts mortgage that most of us really don't pay a lot of attention to. I'm just kind of a policy geek and I like this stuff. CHLA also has a LinkedIn page, and you can find it by looking for Community Home Lenders of America. We have a website that is communitylender.org. We have lots of information. Just start with following me.
Okay,
and I post a lot of stuff.
And I know you're going to the NBA annual.
I am.
In Denver. I'll see you out there. Looking forward to it.
I would not miss it, and I would not miss you.
Yeah, it's a great event put on by some incredible people. Does CHLA collaborate with the NBA?
So we actually do. We do a lot of things, and remember, I am a member of the
Of
OBA. I'm
course.
a
Yeah.
certified mortgage banker. So we do collaborate, and there are often times when there are policy or initiative issues where we are 100% aligned, and the two organizations will co-sign letters together. I think they recently co-signed a letter regarding some of the servicing rule changes that the CFPB is proposing. And then there are other times when something is more of an MBA thing, and we leave it alone
Yeah.
because it's not so impactful to our members. Then there are other times when we're aggressive on things, and we're the only ones that are able to do it for one reason or another.
Well, as someone at IMB, that's what I am. Really appreciate everything that you do and the service that you give to all of us in the name of the consumer, which is really what all of us is all about. I need to get you an All of Us plaque behind you. I'm sure you'd mount that to your wall, and
I was going to tattoo it on my chest.
that would be amazing.
Yeah.
That really would be a distraction too, if I'm to be honest with you, depending on where on your chest it lies. Taylor Stork, thank you very much. I'll see you in Denver.
Thank you, Greg.
All right, we'll talk to you soon. That's Taylor Stork, as he says. Follow him on LinkedIn. Next Monday, we're going to have another special guest. You'll have to wait to hear and see, because I'll be out there in Denver. We're going to grab some really, really impressive folks and have a show. I think we're going to pull it off live from Denver. So, stay tuned in here and be here on Monday at 1 o'clock Eastern time. Until then, thanks so much. Have a great week. Take care.